Hello and welcome to our presentation for Mercer Park Apartments. This is a great property located in Arlington, Texas, and it was brought to me by a couple of brokers at Marcus and Millichap, two of the main ones, Wes Rock and Bard Hoover, and they like this deal so much they're investing in it personally as well. This is an off-market deal. The average price now, even after all the craziness in the market, the average sales comps are about $140,000 per unit, and we're actually buying this at 119,000 units. So that's one of the great parts about this. There's some other great parts. The loan is a great deal. 142 units are already somewhat upgraded. Now, there is Allura. 88 units are on Allura, land use restriction, which means that only 88 units have to be to low income or very low income. So that does put a damper on our rents a little bit. We'll talk about that. It's got a great unit mix. It's in great condition. Like I said, it's an off-market deal brought by brokers Bard and Wes, and they are investing in this as well. It is a loan assumption, and we'll talk about that. But just like I normally do, let me first do this, jump on over to what the partners can expect. Now we are going to be receiving a $6.5 million private equity loan from New York Mortgage Trust. What that does is, the biggest part of that, two big reasons. One is it lowers our capital that we need to raise because we're doing a loan assumption, so it's lower loan to value. And the next part of that is it increases the amount of bonus depreciation for all of our partners because they don't participate. So we will get about an 80 cents on the dollar first year bonus depreciation tax write-off. That is our estimation of what that is. So this section here is what a partner can expect. Year one, we're not budgeting any cash flow. We've got a lot of cushion in there, and we'll go over the reasons why. Year two, about a 3.8% return. Year three, a 17% cash out refinance. Not a lot, but we want to be conservative on our numbers. Another 2% in year four, and our overall return is a 2x multiple, 20% per year average annual return. So let's go over and tell you how we come up with those numbers. Here's the property. It's Mercer Park. It was built in the 80s. Nice property. It's in good shape. The previous owners replaced all the windows, replaced the roof, replaced a lot of siding. Like I said, it's in good shape. We are paying $29,600,000. Closing costs, 1.5 roughly. $2 million in capital improvements, $500,000 in our operating account, which we want to definitely make sure that we have enough cushion, especially in a market like this. Miscellaneous, $82,000, and that's just for extra little costs, but also to round up. We'll have we're assuming a loan of $18,562,000. We'll get preferred equity at $6.5 million. So all we're going to raise is 8.6. So this will fill up actually very, very fast. So we're all in at 33.6, which is $135,000 per unit. Now that's what sales comps are going for right now, $135,000, $140,000 per unit before any CapEx or the other expenses. So we're at 119 when sales comps are at 135, 140. Again, preferred equity, 13% total rate, 6% current pay. That means that they accrue 13% per year, but they only require us to pay 6% per year. So it's kind of like having a 6% interest-only loan with a hefty prepayment penalty is another way to look at it. We're going to look at a 3-year refi to get out of that private equity. There is Allura. The sponsorship team is keeping 20% of the ownership, and there's an acquisition fee of 3%. Plus, we're also paying a $100,000 commission to Marcus and Millichap on our side of it. We were at a higher price. We were over $30 million, negotiating this down to $29.6, by the way. We are assuming our loan, it's an $18,562,000 loan at 3.84% interest. It is interest only for another year after we close. So 3.84, there's 9 years left on this loan. So this is a great deal on the debt. What's nice about it is we're looking at doing a supplemental. Now it says refi, and even though it'll be a supplemental so that we keep the 3.84% return interest rate, we'll keep the 3.4% interest rate, and then the blended rate, I'm looking at 5%. Now, if interest rates are lower than that, then we'll just refinance the whole thing. But if it's a supplemental, we can still do that and have a blended rate probably below 5%. But again, I want to be conservative, especially in this market. Current unit mix. Now, it's exactly the same between the upgraded and the non-upgraded. They already have a whole bunch of units that are already upgraded in some form or fashion. So we're going to upgrade the rest of them, except for maybe the Lura units. We basically upgrade them as people come apply. We need to have 88 units mixed across the board as Lura units. And what that means is a certain percentage has to make less than 80% of AMI, and another certain percentage needs to make 50% or less of AMI. So that really restricts the amount of rent they can charge. Every year in April, the FDIC puts out a statement saying what we can actually rent these units for. So I've taken that adjustment because we don't know which units will be Lura and which won't, because it's as they come up. If we have them, then it has to be a Lura unit. So I took that into account in another place. The rents are already low, so we are going to be raising rents even on the Lura units. We still have room to rent. Average rent right now $11.77. We're only planning on raising $110, so about 10-12% is our total rental rate, which is still below the market. It's 248 units, built in 1984, 8.75 acres, pitched roof, individual HVAC, individually metered. There are 2 boilers, and they're both new. It's in great condition. We put B on that. 3 stories. It's actually 2 stories now that I look at that. And exterior is brick and siding, a slab foundation. Our improvement budget, we have a total of $2 million. Let me give you a breakdown. It's not on here, but interior is the biggest chunk of it. That's to upgrade all the rest of the interiors. Exterior, $400,000, with another $316 in reserves. Here's what that looks like. Roof repairs are about $5,000. We're going to be doing plumbing repairs of about $20,000, and it's mainly to repair cleanouts. $5,000 just to clean and service the boiler and add some repairs in the boiler rooms. HVAC, we budgeted in $100,000 to clean and service all the units, and there's 9 that need to be replaced right now, so we'll replace those as well. There's a barbecue area by the pool. We're going to upgrade that. That's $25,000. We budgeted $4,000 for electrical repairs, $40,000 for exterior lighting, and that's to upgrade, and we'll be saving on utilities with that. Exterior carpentry and paint, we have $80,000 in there. Now, that is a lot of money. However, it does not include, we're not doing a paint change. It's mainly a touch-up, except for a lot of repairs and rotten wood, patio repairs, things like that. So that is mainly for a touch-up because the paint is actually in good condition. It's really the wood that's the problem. Parking lot, spot repair and restripe for $20,000. Termite treatment, $6,000. Dumpster enclosure, $60,000. They're very strict on what they want for dumpster enclosures, but we need to add those in there for beautification and per city request. Carport repairs, $10,000. Landscaping, $15,000 in upgrades. A new sign package, $10,000. So that's $400,000 for the exterior. We've currently got 57 classic units, meaning nothing has been done to those. We're going to spend $570,000 on that, about 10 grand per unit. Partial upgrades, we've got another 80 units. So that's $480,000 we budgeted, or $6,000 per unit. And the ones that already have a full upgrade, we still put in $2,000 in there, and we call it a glorified make ready because there's not a lot needed. Fire suppression, $45 a unit, so $12,000. So our total interior, $1,284,000. We've also got contingency and construction management, et cetera, in there for the cushion. So that's the improvement budget. I didn't put all that into this area like I sometimes do. Okay, let's look at the current operations. Now what we do is we take the current T3 per the owner, T3 on income and T12 on expenses. And we plug that in here to see where we are and what we can do. Now there's a story here. Part of the reason it's a management play. This was managed for quite a while by a company that went out of business, a management company that went out of business. And I think that they were doing a really crappy job at managing it. There is a lot of cleanup that needs to be done on the management side. And we think that the LURA was being run incorrectly, so we need to correct that. But this is the previous management that went out of business. They were doing a horrible job, which is why they went out of business. Then they replaced that owner back in April, that management company back in April. And they've been trying to clean it up, but the property has been for sale, so they haven't been very aggressive in that front, in my opinion. Now, the property, even though it's individually metered, is run as an all bills paid property. They were trying to attract that demographic. So on an all bills paid property, we're going to be changing that over. So our market rent, you can see this over here, right there, right now is 291 times 12 is 3.5. We're raising those rents to 318. So I've got it plugged over here. That means 3,825,000 is gross potential rent. Vacancy and collection loss. They're currently at 20%. I put it at 22%, which is huge. And part of the reason for that is the first year, we need to convert the units from being all bills paid to being individually metered, individually paid. Plus then we need to rub back, which we do with flat fees for water, gas, trash, etc., pest control. And so we bill back flat fees for that. Also on the other income, we have a tech package that we install. It takes about a year to get it installed and all updated. So that's another reason for the higher vacancy and collection loss, is it's going to take time to change all that over. So the first year is kind of a mess with cleanup. Again, a management play. That's our job to fix up. We'll take our other income from 308 to $550,000. Management fee was 108, it's going to be 123. Now it's a 3.5% management fee. And the reason for that is the extra management work involved with the LURA. Current payroll, 344. I'm budgeting 375,000. Now you notice I've got minimum assumptions and aggressive assumptions. This is if I screw up, it's over here. If I do really well, it's over here. But we put it right in the middle as far as what we think we can do. So payroll at 375, contract services at 70,000, general and admin at 85. You notice that they only have 27,000 in general and admin, and that's because how they categorize expenses. So we have to change that around. Make ready and maintenance, they're only saying $51,000. We had to bump that up to 130. And even though we're spending $2 million on CapEx, I really firmly believe that is going to be much lower year one, especially during the rehab time. But we have to plug that in because it gets translated over to our 5-year projections. 30,000 on marketing, 350,000 on utilities. Now you notice they're at 420 and we're at 350. And the reason is we're switching from all bills paid to individually metered. So that will go down over time, and another reason for the mess the first year. Insurance at 130,000 and property taxes at 600. Gives total expenses of about $7,600 per unit, net operating income of 1.6. Now we've got company expenses, tax returns, asset management fees, different things like that. Below the line expenses, those are here. Plus I put in $400 per unit in reserves. That's not what the lender requires, but that's really what it runs to go ahead and operate a property. To have, again, the reserves, those are replacement reserves. So if we replace a refrigerator, it goes below the line, not up in our maintenance expenses. So that's what goes down here. Pref equity, I don't have in this section because I wanted to see what the property was going to do. And so I have it in a following section. Debt service, 712,000. That's an interest only from our loan there. One more year. Sorry. Cash flow, $750,000 year one. Now you're saying, wait a minute, didn't you say there's zero cash flow year one? We'll get to that. Debt coverage ratio, 2.3, cap rate, 5.5 on projection. Now, their cap rate on actual is 4.7 and tax adjusted at 4.4. So a little bit low, but that's one of the reasons why, the reason it's low is because we do have the great debt on there. This would be an 8.7 year one cash on cash return. However, we have pref equity we've got to take out and some other items. And I'll show you about that here in a second. So we take our sponsor pro forma, and then we take it and carry it forward over to a 5-year projection. Okay. So these are all calculated numbers, all of our income and expense based on these assumptions. Year one, I put at a 14% collection loss plus an 8% vacancy loss. That's where we come up with the 22% here. Okay. Vacancy loss remains constant. We just assume an 8% vacancy. Year two, we still think we can, with how high inflation is, increase our rents by 6%, and then 4.5%, then 3 and 3. Expenses going up 3%, 3%, 2%, 2%. And our collection loss, because of that turnover, getting it down the first year, working on the property the first year, then I put 7% collection loss in here, and that's to adjust for the LURA units. So that's where I do our collection loss for those units that we have to take lower rent on. So that's adjusted here on collection loss, okay? Expenses grow, income grows, but the good part here, well, just what I put in here. I put in an extra $275,000 in cushion in year one. Again, on a value play, especially when we're turning around this way, I don't want to make any promises on distributions year one. I'd rather people be pleasantly surprised if we don't need it, but if we do need it, it's there. So again, under promise, over deliver is the goal. Along with transparency, I show you all the numbers, how we came up with them, etc. So we go out 3 years. Okay, year three, I'm assuming a 5% cap rate in year three. Now cap rates are going to be ticking up again, and then they'll start coming down. And so that's why I put in a 5% right now. That would assume a value of $43,700,000. We'll do a 65% cash out refi. That's really a supplemental, but the total loan amount will be 28. I put in paying off the existing loan, and then paying off the preferred equity. You notice that we got a loan of 6.5, but we have to pay off 7.9. That's because of 2 reasons. One is they do have a minimum multiple that they need to hit. And also because we're paying them 13% interest. They're accruing 13% interest, but we're only paying 6. Because of that, we accrue and our payoff goes up. So I can almost think of it, we're getting a 6% loan, but we have a hefty prepayment penalty. So our net proceeds $1.8 million. Now at the end of year 5, I use the same 5 cap for $47 million, 2% in costs, pay off the existing loan, and have proceeds of $17 million. Okay, so that's how we're coming up with our valuation is a 5 cap. Nobody ever shares that with you, by the way. So those numbers come back up here to what the property would do. Then I'm coming in, okay, so our cash flow, 473. We're accruing 13% in pref, so we owe 845, but we're paying 390. Okay, so the pref balance goes up because of that accrual. That makes our cash flow $83,000. Again, that has $275,000 in cushion in there as well. And that's the 83,000 that gets switched over to go down here. And then you get your pro rata share. $100,000 partner, for example, would get 775. Okay. Same thing goes for year 2 and year 3. Now, year 2, the pref payment actually, in year 2, our interest only on our first loan goes up, which was over here. Goes from 712 to 1,052. Now it is amortizing. So we actually get some loan payoff there. And year 2 is the same thing. Now, year 3, because we do the refinance, then our payment goes up. On our pref equity, years 1 and 2 are 6% current pay. Okay, but year 3 is an 8% current pay. So that payment goes up. Okay, and actually, that did not make it in the spreadsheet. So change that. Again, doesn't really change, doesn't change our overall number at all, because rather than accruing, it's being paid. Okay, so we pay off our pref when we sell it. When we refinance it in year 3, $2 million in sales proceeds comes down here to the amount that you would get as an investor, $933,000. So it did bump up the amount of tax. So it did bump up the amount of, God, what am I trying to say? So it did bump up the cash out refi that you get in year 3. Okay. This is the ownership percentages based on how much anybody would invest. Again, we're raising $8.6 million. Here's our uses, which was from the front page again, which means we're at $135,000 all in. Even in year 5, this is what gets me. In year 5, I'm projecting a $47 million valuation. That's $190,000 per unit. At the beginning of the year, they probably could have got $180,000 per unit. So this debt market, because of that, has changed the valuations, and I'm still very conservative on my $190,000 per unit valuation in year 5. Okay, so here's some things that we can look at just for grins. Let's just say that in year 5, the cap rates go back down to 4.5. Okay, I'm changing 4.5 on our valuation, and you can see the total return here. That goes from being 20% to 29%, just with the half point difference on the exit cap rate. And that makes the biggest difference on your overall value. So that's one cushion in here. Again, looking at the cushions, the $275,000 I'm taking out year 1 out of the cash flow. The high vacancy and collection loss that I'm using. The extra cash up here, we've got $500,000 in the bank and an extra $82,000 here. We've got cushion built in all over the place. We think this is a great investment. We're going to raise 8.6, and I would imagine we'll be full within about a week or 2. So if you're interested, get involved in this. Again, we're also looking at an 80 cents on the dollar first year tax deduction, and that's huge. That is absolutely huge. So this is Mercer Park, and that's what we wanted to show to you today. And again, a great investment, pretty property, management play, 20% per year average annual return off of our conservative numbers. And we're buying at a discount on this off-market deal. And we love it. And we're going to be closing on it by the end of the year, and love to have you as a partner. Thank you so much. I appreciate it. All right, bye.